Many investment advisors and financial influencers swear by passive investing in the index funds. Everybody says just buy the index. But what if I told you that the most popular trade or investment strategy in this world is headed for a crowded exit? Just look at the market right now. Does this market give you a comforting feeling that your investment is across a diversified portfolio of assets? Let's shatter your feeling. Welcome to the hidden game. In this video, let's talk about the central problem with index funds. So what makes me qualified to talk about this topic? I've had academic education and professional experience working in investment management and quant research for over a decade. My expertise lies in US equity market, so I know what I'm talking about. Let's talk about S&P 500, for example. The tech sector is carrying the whole index forward. Nvidia, just as an example, can drop $1 billion in market capitalization and the whole market feels the effect of it. It is that the bigger names are getting bigger and bigger, and the basket of the true influencers of the index are getting short, and everybody continues to feel that this is one of the most diversified investment assets in the equities market. That is a complete lie. The index fund is not a magic pill. Index fund is a strategy, and this strategy depends on a lot of investors and individuals doing the hard work of corporate research, of valuation and asset pricing. When a lot of investors pile up on the index fund, the game completely changes. The way the market is looking right now is that this strategy, the index fund strategy, is looking like a crowded market of a lot of trades piling in select few stocks and equities. As of June 2026, the market capitalization of the technology sector stocks in S&P 500 rose to 39.4% of the total market capitalization. This is higher than the dot-com era peak as well. This is not the diversification that index investors are looking for. This is when the index is leaning harder and harder towards a select few giant technology companies. What this leads to is a day like June 5th, 2026, when the US traded artificial intelligence stock companies, or rather US traded chip makers, they lost over $1 trillion in market valuations. We are talking about companies like AMD, Nvidia, Broadcom. They all got slammed. Nvidia alone lost 6% of the market valuation, which is close to $300 billion. And this is the reality, that a lot of index fund investors, they go invest in index funds looking for diversification. But what they end up getting is that their funds get allocated to the same artificial intelligence or technology giants over and over again. When a lot of investor funds get piled onto these index funds, then what this leads to is a different kind of question. And the question is, what if this basket of stock itself becomes a crowd trade? So this is where the game theory comes in. One of the questions that index fund investors find really hard to answer is who is providing the research for asset allocation. And the correct answer is that index fund investors are not doing it. Somebody has to perform the corporate research to understand what the company is doing. Index fund investors are not doing that. Somebody has to perform the company valuation and asset pricing. The index fund investor is not doing that. Somebody has to put in the work to figure out if a stock or an equity symbol is underbought or overbought, undersold or overbought. And the index fund investor is not doing that. So what is that the index fund investor is doing? Index fund investor is riding the research. It is fine if few people do it. It brings us to a different kind of problem if a lot of people start following this passive investment strategy. Let's understand this from the prisoner's dilemma angle. From an individual investor's point of view, the rational choice or the rational decision is to minimize their investment cost by minimizing the amount of research that has to be done and just follow the index for their investment allocation. But when you look at it in a collective form, when large number of participants are following the same strategy, fewer and fewer people have the incentive to put in the cost for doing the research of figuring out what is worth owning and what is not worth owning. So the individual strategy makes sense. It is the collective outcome of these strategies that actually starts to look worse, which is classical prisoner's dilemma if you have seen our previous videos, where individual strategy is logical, it makes sense, but the collective outcome is fragile, and index funds are right in the middle of this situation. So the research shows that the markets cannot be efficient if the information production and information consumption is too costly. In other words, if there is no incentive to do the research, then fewer and fewer people will actively do the research. So next time when you hear someone say, just buy the index, what they are actually saying is that you go ahead, buy the asset based on the index, while someone else takes care of researching the allocation and what is worth owning. Now, this may sound smart as an individual investor, but when you are looking at it from a collective point of view, it appears that the system has started to warp. This warping is not going to happen sometime in distant future. This warping is happening right now in the market that we are observing. Market is increasingly being driven by select few giant technology companies. Nvidia is perhaps the best example to show this. Small changes in Nvidia's market capitalization or even the guidance of future changes the market in a really significant way. And what this appears to be is like a really small group of stocks being traded, and they are being labeled as a portfolio on top of it. So what this means for the current and future index fund investors: the index fund investor is walking into a market space where the current giants of current technology giants are already overpriced and oversized. The upcoming giants, technology giants, are currently private, so the investors haven't had any chance to observe their business profitability, and the onus of carrying the benchmark is consolidated within a select few handful names of technology companies. So makes you stop and think, are you still feeling comfortable investing in index funds? Look, this story is about feedback loop. As more and more capital chase the passive index funds, what this leads to is that bigger companies of that basket become even bigger, and with time the market breadth becomes narrower and narrower, and the co-movement of assets and indexes, or rather correlated movements of the assets and indexes, start to increase. What this doesn't look like is a diversified portfolio. What it again looks like is like select few companies, and you have a logo of an index on that. This is not the market of future. This is the market that we are currently in right now. Look at the current pipeline of IPOs that we are about to get in 2026. 2026 is bringing a blockbuster list of IPOs. We are talking about Anthropic and OpenAI and SpaceX. SpaceX might be coming in as early as June 2026. So SpaceX can itself become the biggest IPO in history if its current market valuations hold. The index providers and exchanges, they are bending over backward to maximize their gain from these IPOs. Nasdaq 100, for example, they are changing their rules to accommodate these IPOs. What they're essentially saying is that if a company's market valuation stays within the top 40 companies, their adoption to the index can be fast-tracked within 15 trading days. FTSE Russell went a step further. Back in February 2026, they proposed a framework and a set of rules to fast-track the major IPOs into their indexes in as early as 5 trading days. and kind of completely forego their quarterly rebalancing period. On the flip side, S&P 500 evaluated and eventually rejected the proposal to fast track the induction of the major IPOs. This was done in effort to protect the passive investment funds linked to S&P 500 and save the investors from the ensuing volatility of these big IPOs. And this matters a lot because next wave of companies coming up for these indices are not even public companies as of now. So the investors haven't had really a chance to observe these companies, build a profitable business, and use the public investors' money wisely. These index funds stop looking like a humble trading instrument for passive investing, and they start looking more like tools for funneling the capital from investors to the same select group of large technology corporations. Nvidia, just as an example, when that Nvidia stock goes up, the index chases it. As index is chasing the higher valuation of Nvidia, more and more fund from the index fund investors, they are directed again to Nvidia to buy more of it, and just keeping the feedback loop, the positive feedback loop going. Somehow people believe that their passive index funds will absorb the shock of this positive feedback loop, which is going to accelerate even further with time. This is not a robust investment instrument. This is a crowd trade linked to someone's life savings or someone's retirement account. So go ahead and buy that index fund if you want it, but do not confuse the popularity of an index fund with the safety. Do not confuse the low cost model with zero consequences, and do not consider the passiveness of these index funds as somehow a guarantee for harmlessness. Because if everybody is indexing into the same market leaders, somebody has to go ahead and do the hard work of figuring out what is worth owning. If nobody is figuring that part out, then the index itself becomes a risky asset. Now, I'm not a financial advisor. I cannot absolutely tell you what you should do with your money, but I can make 3 predictions on the index funds in the US market going forward. Prediction number 1, a lot of indices in US market will be forced to bring in or at fast track the adoption of these major IPOs coming up. S&P 500 will be under tremendous pressure to bring these major IPOs in its ambit as well. Second prediction is, unless there are major restructuring in these index funds to limit the market cap requirements, or unless there are clear incentives for the investors to perform the active research, we will continue to see that these indices, they will not represent the broad economy. They will stop providing that broad economy exposure to the investors. What this means for the investors is that as a result of these major IPOs, these index related funds will see a major drawdown going forward, because the investors will not have the ability to observe the business profitability of these businesses that are coming up. And the third prediction is that the leaving the index funds completely may not be a wise choice either, because nobody knows how the future will play out for these index funds. So truly finding a true hedge of your portfolio is going to be of utmost importance going forward. With that said, I will end the video here. If you liked what we talked about in this video, please like and subscribe the channel. I'll see you in the next one. Thank you.